All right, earlier in the month, my next guest published a report titled Pricing a CapEx Supercycle. I'm going to bring in Barclays Investment Bank Head of U.S. Equity Strategy and Global Equity Linked Strategies, Venu Krishna. You know, Venu, you've had a hot hand, my man, and and the market has kept up, right? It's been really tough. What I thought was interesting, though, you're pricing in a CapEx supercycle. As AI investment scales to levels rivaling the CapEx supercycles of the 1990s and 2000s, doesn't it supersede those? I mean, I see all kinds of different charts and stories, and it's the only thing that's ever been bigger is the railroads or the Louisiana Purchase. Isn't this brand new territory for CapEx?
It depends on what you're normalizing it by, right? So, for example, looking at it in absolute dollar terms, you're right. In this case, we look at relative to the operating cash flows of the company. So if you look at that, actually, the spending was greater during the dot-com bubble by the companies who were spending.
Okay, I got you. So that puts it in an interesting perspective.
Yeah.
Then it feels less risky in terms of, like, you know, because the way it's the narrative in the financial media is, for the most part, now it's become reckless. They've used up all their free cash flow. They've gone to the bond market. They've used that up. Now they're going to use equities. They've used that up. Is that a proper narrative?
No, it's not. So I think now, on one hand, let's take a step back. The scale of capital spending is definitely very high, right? And the important thing is where the market is getting a little antsy is that peak keeps getting pushed further out, right? So for example, our own analysts on the fundamental side took the view about 6 weeks ago that the peak is in 28. More recently, about a week or two ago, they reassessed because of accelerating demand, faster adoption of AI, that the peak is now moved to 29, right? And so the question is, they're spending more. If you look at versus their own cash flows, right, we are estimating that they'll be spending about 90+% of their cash flows for the next few years. But one, they're highly, highly profitable. Two, they have access to a lot of liquidity. So they've gone to the bond market, yes, and now they're going to the equity market. Right. But when they go to the equity market, they also diversify their funding streams, create more debt capacity, sort of give a positive signal to the credit markets because of the equity cushion.
Right.
And now they're also going to the convertible bond market, which is basically embeds an equity option in it. That market, for example, has raised about $87 billion year to date, the fastest raise in its history. Right. So I think what these companies are doing is they're accessing a broad source of funding to keep these levels of spending going. The question that raises is, how do you think about extracting profitability from this scale of spending? Right. So they're already extracting it, but the scale is so high, it does create some uncertainty.
This return on investment that a lot of folks, they became really concerned about it last year. It was a big deal. But I feel like Wall Street is looking at it in too narrow of a time frame. I don't think these big firms are saying, hey, we need to have, return on investment. We got to prove it next week and next month, next quarter. And this is why I see a big disconnect in my mind between Wall Street and what these hyperscalers and other folks are trying to achieve. But I want to switch gears a little bit because, you were bullish when a lot of your colleagues weren't. Your base case, 7650, we're there.
Yeah.
Are you sharpening the pencil at all?
Yes, we are.
Okay.
Interestingly, because we do that typically in the middle of the year.
Right.
Once the Q1 earnings are done, we have a sense of where the guidance is. What I can tell you in everything we've written so far, the direction is to the right.
Okay.
Right? And so in a short period, we will be having our views like we do every year. But it's very clear that we remain optimistic, but I would say cautiously so, because you've had a lot of recovery. We had a big hiccup in leading into March of this year. But overall, our view is that adoption is increasing, spending is increasing. The AI capex or dollars are flowing to a much broader cross-section of industries, from energy to parts of industrials to other parts of technology outside of hyperscalers. So, we see that it is this strong momentum in earnings, which is probably the single most important thing in the market right now.
I want to talk about some of your ideas, the technology, because you've been bullish on tech since the fourth quarter of 2022. Right when ChatGPT came out, it caught a lot of folks flat-footed. You were bullish, your firm. Your best position, semiconductor, semicap, NVIDIA, Credo, Broadcom, and MTSI. I feel like we're starting to get some differentiation now. That Broadcom earnings report seemed to disappoint a lot of people. The stock has been under some pressure. In the meantime, Credo shook off concerns about copper. It's become a juggernaut. MTSI last week had a hell of a week. All these semiconductor equipment names did. We just talked about sharpening the pencil. Are we getting to a point where even if it's semiconductors or let's say mega caps, that you have to start to really differentiate the names even more?
Absolutely. In fact, one of the biggest trends we pointed out last year, and even more so this year, is that if you look at correlations in the market today, within S&P, pairwise stock correlations, you look at correlations between sectors, within sectors, it is at historic lows right now. In other words, the other side to that coin is that dispersion of returns is at all-time highs.
Right.
That's why if you look at the difference between single name volatility and index volatility, that spread is at historic highs. So what that's telling you is that this is a market which is in principle an active manager's delight, right? Because dispersion is so high.
It's a stock picker's market.
Exactly. And when you think about, for example, semis, you took the example of that. It's a wonderful situation in which, for example, if you look at certain parts of the semi industry like equipment, they are trading at much higher multiples. And it's almost suggesting as if the capex cycle is going to be much longer. On the other hand, if you look at names like NVIDIA, it's telling you as if the capex cycle is just around the corner because they're trading at much lower multiples, right? So both cannot be right.
Right.
So I think that's what leads to the potential to be able to be a good stock picker, or at the very least as an alternative to pick sub-themes within the market rather than being more general saying, I like tech or I like industrials.
Right. That's you'll do okay, but you can really do extremely well if you can zero in, like you said, subsectors, specific names. Manu, thank you very much. Appreciate it.